So I'm going to jump into taxable. Matt, obviously, with everything that's taken place with Iran, and even in the first 2 months of the quarter, but most recently going into April, the yield curve is the story, and particularly the front end.
Yes, I think we started with macro, we talked about equities. I think it's all connected. What's interesting, but before Iran coming into this year, we thought it was an attractive time, and we still think it's an attractive time to lean into duration overweights modestly in the front end of the US yield curve. Now, there's a whole host of reasons for that. The Fed has started their rate cutting cycle back in September of 2024. They've cut rates 175 basis points, and yet 5-year and 10-year yields are higher. That doesn't happen very often. And I think there's some interesting reasons why yields haven't followed Fed rates lower. Part of it is because budget deficits continue to be quite elevated, and there's no real political will to address that. Part of that is based on concerns that you have a new Fed chair coming in. We're not sure exactly how that's going to play out. We know how it's going to play out, just the timing. But it also kind of puts some uncomfortable thoughts in the mind that, look, as the FOMC balance of power begins to potentially change second half of this year, maybe the Fed's going to cut rates a little bit more aggressively here. Fiscal dominance is what I think investors would think about longer term. To us, recommendation was to be modestly overweight U.S. duration. Nominal and real yields look attractive. Fed is likely to cut rates. Eric talked about that. We think they cut a little bit more aggressively than what the Fed market currently has priced in. But margin of safety is also attractive for the front end of the U.S. yield curve. There's almost $8 trillion sitting in money market products, waiting for the Fed to convince markets they're going to cut and then deliver rate cuts. And I think that gives you some comfort that, if that trinity becomes a little bit more concerning, which we talked about before, the Fed has plenty of powder to cut rates more aggressively. Now, post-Iran, our recommendations really haven't changed too much. Yields, you can see on the far left-hand side, 5-year yields spiked, 10-year yields spiked about 50 basis points intra-month. As Walt labeled it, it's a more attractive entry point, we think, for us in high-quality fixed income. You're getting a lot more yield. The U.S. economy has been extremely resilient for the last 4 or 5 years. 2022, you had the oil price shock with Russia and Ukraine, right? The U.S. powered through that. 2023, you had the regional bank crisis. The U.S. economy powered through that. 2025, you had Liberation Day, right? The labor supply shock. The U.S. economy is powered through that as well. This year, we had the AI shock, direct pressure on software, right? A little bit more concerns in private credit, leveraged loans, not so much on public credit markets. We're recommending an overweight in public credit, but up in quality is the bias. It's just another shock, right? So, and not to discount this too much, but historically, unless you have a large exogenous shock, right, that feeds through to weak labor markets or instability and weakness in financial markets, the time to get overly worried about the U.S. economy, unless those things happen, is not now. We're not seeing that. When we look at stability of financial markets, if you look at funding rates, right? If you look at CP levels, if you look at basis swaps, if you look at the amount of global corporate deals that were conducted in Q1, right? It was the strongest Q1 for mergers and acquisitions and IPOs ever, right? Public credit is wide open. People are not overly worried yet. And we don't see the plumbing of the financial system coming under tremendous pressure here. If we were to boil it all down to one thing to watch, I think you'd watch labor markets really closely. I think the reaction function of the Fed, if they were more worried about labor markets coming under pressure, would deliver those rate cuts faster than what the markets have priced in.
Yeah, and I would say, look, what Eric was saying earlier about, and both of us were talking about the shocks continuing to push things up, right? The flip side of that is as inflation stays higher, then rates stay higher. I mentioned the CPI was 1.8 for a decade. Real yields, inflation-adjusted yields, in many parts of the developed world and parts of the curve were negative back at that time, or near zero. they've been buoyed and sticking around at these elevated levels. And so for many years, the real story of bond markets, credit, high grade, it doesn't matter, has really been rates and the shape of the curve. I'm looking over munis when I think about the shape of the curve. And so I have often talked about it almost like a stay of execution, that if you didn't have some of these things, rates would have come down a little bit sooner. So taking advantage of where this is at and when you get those things pop up, here where we've seen yields go up, it's largely on the back of inflation expectations in the shorter part of the curve. If that doesn't come to pass, if it does come to pass, that's compensation for that inflation. If it does come to pass, or doesn't come to pass, that inflation jumps and stays at that level for that amount of time, that extra level of yield turns into inflation adjusted yield, so-called real yield, because the inflation that was expected never actually shows. It's why I continue to talk about managing duration, having an opinion, knowing where on the curve you want to invest, because I do believe this is an elevated opportunity to where neutral would be in the absence of all of these shocks that we've seen over time. And so even as we get into IG, it's first and foremost a rate story, but let's talk a little bit about the IG side.
Credit looks attractive, especially on the public side, right? In the last post-COVID world, consumers and more importantly, corporations have been relatively conservative with their balance sheets. And so in March, in Q1, yields have increased on the back of concerns that inflation would feed through and expectations might rise. And so again, you're getting a better buying opportunity. Credit spreads have widened a little bit. High yield credit spreads widened by about 25 basis points in the first quarter. In the last couple of days, they've retraced almost all of that. Our advice has been coming into the Iran shock and post that you're supposed to take advantage of the extra credit that credit spreads offer, but you're supposed to do it in a conservative fashion. And so you're supposed to lean a little bit more aggressively in the investment grade space. Triple B credit spreads offer attractive compensation for potential volatility. Defaults don't happen very often in the investment grade side. And within high yield, you're really supposed to concentrate in double B high yield type credit, where again, defaults are relatively modest. But the average compensation just doesn't make a lot of sense if you start to dip more aggressively in a triple C type.
And you talk about that as a higher quality, high yield, if you will.
Exactly. And so you can see the average yields, because Rick talked about the Fed aggressively raised rates in 22 and 23 and has only conservatively cut rates so far. Absolute all-in yields means that the forward returns still look pretty good for credit. Now, you want to minimize potential defaults, you want to minimize potential drawdowns, right? If an exogenous shock like Iran continues or another one comes in, you want to make sure that you are not potentially impairing your capital here. So take advantage of the yield, but do it with shorter duration, higher quality, public credit sensitive investments.
And then if we're talking about, so this sort of, I'll call it a phenomenon of a higher risk-free rate, and then the sort of reaction function of spreads.
Yeah, and so this is an open question as to where are short-term funding rates going to go. If they remain here, I think leaning into higher quality credit means that no matter where funding rates go, you're not going to end up with potential distress, restructuring, liability management exercised by these corporations. The probability of default or restructuring is pretty low for lower quality bonds. The break-even rate on the right-hand side shows that because the spread duration on high yield in the index is so short, you have a lot of margin of safety for spreads to widen before you start to eat into that extra spread offer.
And we've talked about this before, but one of the important things about high yield is just the nature of the index itself. Its composition's really changed quite a bit. For those that haven't heard it, maybe just pop through some of these visuals.
On the far left-hand side, you can see that the average credit quality of the index has improved pretty dramatically. A couple of notches here is really close to double B, and that means your expected default rate kind of decreases in a linear fashion because the quality is just much better. Now, post 2020, you had a lot of fallen angels, formerly very large capital fused companies being downgraded to double B, and that brings the average credit quality index much higher. The duration has shrunk pretty aggressively also in the last 4 or 5 years here. And that means that the ability to refinance has changed, right? And so your spread duration and price sensitivity, that if spreads widen for any reason like Iran, right? Because the spread duration is so low, the price change is going to be pretty limited. If you're looking at a spread duration of sub-3 versus 4.5, for every 100 basis points of spread widening, that saves you 150 basis points of drawdowns here. Obviously, defaults are more of a concern, but drawdowns are something that you want to be able to play offense. And again, owning a high yield product with a spread duration of sub-3 means that you're going to have a lot less price drawdowns if credits generally widen.
And you mentioned the let's stay with this up in quality idea. So from double Bs to triple Bs, same idea where this pickup is from a risk-adjusted basis.
Yeah, so owning triple Bs, on average, these large multinational corporations fund themselves off the yield curve. And so you're owning kind of 5, 6, 7, 8-year type bonds. The high yield, as we talked about before, typically fund themselves 4 years and in. And so you're picking up extra yield compensation from lending money to companies who are investment grade rated, but have a longer tenor. And again, that's based on partly the shape of the US Treasury yield curve. As we talked about before, Fed's cut rates and yet 10-year yields continue to rise. For us as investors, that means more yield for us without taking on more credit risk to do so. And so shifting an allocation from short dated high yield into a little bit longer dated triple B bonds, again, makes sense to us. There's a big overlap in yield to worst between yield to worst on triple B versus double B. If you can get the same or similar yields with taking much less credit risk, you're supposed to do that trade.